Thank you for visiting DIYBizPlan.com or CapitalBusinessPlan.com. Just so you know, both sites take you to the same free business planning software. So once you go to either site, on the top right hand of the page you'll see a button for user login. On the Capital Business Plan site, it's up here on the top right hand side also. As a note, the software requires Internet Explorer for use. That's because the text editor is not compatible with other browsers. So today what I want to work with you on is how to complete a set of financial projections for your new or startup business. So to get there, we have to have created an account. So the assumption is you have already registered an account. So I'm just going to log in under my admin account. To get past the cover page creation screen, you'll have to at least enter in a company name, but these other fields just help create a cover page for the business plan software. So once we move past the company information tab, you can see that we've got the 6 sections of the business plan, which are expandable so that you can fill out each of the 6 sections. But what we're looking for here for the purposes of this video is the basic financial projections. Actually, we have not just basic financial projections in here, but 3 different Excel spreadsheets for you to utilize. The first one is our basic financial projections. That creates a 1-year by the month pro forma for your company. The intermediate creates the same 1-year monthly spreadsheets plus 3 years of annual income, cash flow, and balance sheet projections. And then finally we have the advanced financial projections, which is for more complex projects. This one not only has 3 years of income, balance sheet, profit and loss, it also has all the critical assumptions, more advanced payment of payables, collection of receivables, depreciation schedules, the whole 9 yards. So for today, what I want to walk through with you is how to fill out the intermediate financial projection software. So what we're going to do is click on the download button, and you'll see that there's a dialog box asking you what do you want to do with this file. Rather than just open it, what I would suggest to you is to save it as, because otherwise it'll open in a temporary folder on your computer, and if you don't remember to save it later, it could possibly get lost or deleted. And then what you can go ahead and do is open it from that location rather than opening it from the website. Normally this program is locked. Right now we've got it free. So normally there would be a code that would be emailed to you, and you'd enter in that code here, and that would unlock the program. So what I'm going to do is base this set of financial projections actually on this sample business plan that's in here. It's called Vinny's Pizza. This is actually a pizza place that a business partner of mine and I actually did open. So this is based on real information, real statistics. We'll come back and refer to this business plan, especially this market potential section, as we go through and fill out the financial projections. The first thing that we're going to do here is enter in any assets that we're placing into service. So this would be any assets that you could use in the business that you already own. So for the example that we're using here of the Vinny's Pizza, the only thing that we had acquired before the restaurant opened was a point of sale, touchscreen computer with software on it to enter in orders from customers. So really the cost of that was $3,000, and so we're going to put that in under minor equipment. There's a description down here of what constitutes minor equipment and what constitutes major equipment, furniture and fixtures. But this is where you're going to put that stuff in if you already own it. So the next thing we're going to do is go to the Startup Costs tab. And here, because we're renting a retail space for our pizza place, it was delivery carryout only, so we didn't need a whole lot of space. But because we were renting, we're going to put zeros in land and building. Only put an amount in land and building if you're purchasing. Don't put rent in there, don't put rent deposits, any of that kind of stuff. That's actually going to go down here in working capital. So rent and building were zeros. As I said, we had purchased the $3,000 point of sale software, and we paid cash for that. So we don't have to enter that in here under minor equipment because it's already been entered. So other than that point of sale computer, we had spent roughly $15,000 on ovens, refrigeration, freezers, other minor equipment that we used for cooking pizzas or preparing food. And then we had another $10,000 that we had spent in furniture and fixtures. And so that would be point of sale cabinetry. Your sign is considered a fixture because it's affixed to the wall. So, signage, that was a couple $1,000. Point of sale cabinetry, office desk, those kinds of things, chairs for the front of the space. The initial inventory for the restaurant was about $4,000. The renovations for the space were we negotiated for our landlord to pay for the renovations. The total cost of that was about $8,000. And then on top of that, we had about $20,000 in cash or working capital. Our startup intangibles, things like registering the business, paying for trade name registration, health inspections, things like that, were about $500. So basically that's what we had for our startup costs, was $15,000 in minor equipment, $10,000 in furniture and fixtures, initial inventory of $4,000, fit up of $8,000. Remember, that was provided for by the landlord. $20,000 in working capital, $500 in intangibles, plus the $3,000 that we're placing into service on the tab before. So then if we go to the funding tab, we can see that the point of sale is already over here in terms of assets placed into service. That's why we don't have to add it in twice. We actually funded this with our own money. We had about $50,000 of our own money that we were going to put in, and then plus the $8,000 that the landlord put in. So I'm going to put that here under investor equity, so you can see that the total left is $49,500. We provided that on our own, but let's say that you didn't have the $49,500 to invest. A bank is going to require total equity investment in the company to be about 20% is typical. Sometimes you can get away with less, 15, 10%. Sometimes it's more depending on the risk of the venture. So you can see that the $3,000 that we provided plus the $8,000 fit up that the landlord was providing gets us pretty close to that 20%. But let's just say for posterity that we were going to put in another $5,000 cash to reduce the size of the loan to make it more palatable for them. So that means that what's left here to finance is $44,500. You'll see this warning here that says total loan financing must equal total financing needed. So that means these loans down here, the line of credit, the loan number 1, term loan number 1, term loan number 2, has to add up to $44,500. For simplicity, let's just say that a bank is going to allow us to fund that total amount. You see when we enter in $44,500 that red warning disappears. So I'll do that again. $44,500. It disappears. The interest rate, let's just say it's 6%. Currently rates are really low. Typical business loans are about 2.5% over prime to 4 or 5% over prime rate. So the loan term, typically for the purposes of the loan, if it's for real estate, you're looking at 15 to 20 years. If it's for long-term equipment like manufacturing equipment or heavy equipment with a very long useful life, you might get 8 or 10 years. For typical equipment like restaurant equipment that we're talking about here, 5 to 7 years is the norm. And then working capital loans are generally anywhere from lines of credit, which are 1 year long, all the way up to 5 years for what we call permanent working capital loans. So I'm just going to say for this, let's say it's a 5-year loan, that'd be an $860 a month payment. The next tab then is the sales for the restaurant. So we're going to put in here, we had food and beverages. Food sales are going back to our business plan. You can see that the market size actually was not very big. It was a small town, approximately 13,000 people. It did have a campus there with roughly 2,000 people in college. And so we had our target market, student population, working class, families. We had done market research on the market trends, found out that about 51% of the pizza industry is independents versus the chain stores like Domino's and that kind of thing. And then we took a look at our competition so that we could see, well, who are we up against? Domino's, Pizza Hut, there's a chain called Pizza Ranch from around the area. So what we did is took the market information here of the number of potential clients at the university, the number of potential clients in the city, broke that down on a monthly basis based on a market capture that we found for industry analysis, and came up with projected sales of about $360,000. The bottom end of that being of our bracket being $178,000 or $180,000 of sales projections. That would be about 50% of the market that frequents independent pizza chains versus the big name franchises. So if we said, well, $180,000 was sort of the bottom of our bracket and $300,000 is the top of our bracket, we sort of wanted to pick a conservative average of that and say, well, we're probably around $240,000 a year. $240,000 a year is equal to about $20,000 a month. And so, you could put in $20,000 here, but just so that you note, it's not like the day that you open, you're going to have, $20,000 a month. The next month's going to be $20,000. Generally, businesses have what are called a startup curve. And so maybe the first month is a little less than $20,000 because you're doing a soft open. The next month might be more than $20,000 because when a new restaurant opens up, people tend to go to it, try it out. It's the new place. It's always busy, that kind of thing. And then that sort of trails off into the months, the waning months of the business. So then we also had beverages. Beverages were not a significant portion of our sales. So I'm just going to say about 10% of our food sales were beverages. We also had sides and things like that, but we can include those in the food portion there. If you had beer, you could put in beer, wine, liquor, that kind of stuff. You have other tabs here to put in more sources. So then the next step is to put in our cost of goods for our food. And so, if you think about a markup of 4 times, that's a cost of goods sold of 1 over 4, which is 25%. A markup of 3 times is 1 over 3. So if you put in 1 over 3, you get 33%. And so that's where we were at, was our food cost was about 33% of what we sold it for, therefore a 3 times markup. Our beverage cost was 2 times markup because Coke and Pepsi, 2 liters, those kind of things, if you don't order them in massive quantities, you don't quite get the pricing that Walmart and those kind of places could get. So 33% cost of goods sold for pizza and food, 50% cost of goods sold for beverages. For your business, you can split it up however you want. My recommendation is that you make categories up here based on the markup of those items. So if you have a retail store with 10,000 items, we'll group them into types of products that have similar markups, and then go ahead and plug those in that way. Future sales growth. So for year 2, we said, well, we're at $228,000 for the first year, and we were thinking about a $300,000 total market share. We didn't think we were going to get there immediately. 15-20% growth is conceivable in the second year, because you're still growing new customers, people still haven't tried you out, and then tapering off to say a 5 or 10% growth in year 3. For your business, collection of receivables. For us, we got paid cash, credit card or check. Those are all cash because you're not waiting 30 days or 60 days to get paid. If you do business to business, you might have, half your sales cash and half of them credit. Note that this has to equal 100%, otherwise you're not collecting all of your sales. So when you do it, make sure it equals 100%, 40 or 50% and 50%, or whatever it is. For us, it was 100% cash. Our suppliers, we had 30 days to pay for our food. If you're beer, wine, liquor, it's usually cash on delivery, or at the very most 7 days, I think, on liquor. But beer, I think, is always cash. So just consider consider your receivables and payable percentages moving forward. Now we'll go on to expenses. So directors' salaries, that's owners' salaries. My business partner was a manager of the restaurant. He was paid $30,000 a year to run the restaurant, so we'll put in $2,500 there. We had other employees. We had 6 of them. They worked an average of 20 hours a week. They got paid an average of $9 an hour. So 6 times 20 hours per week times $9 per hour times 50 weeks in a year, and we'll divide that by 12. That's about $4,500 a month in salaries. You can create your own schedules to determine what your monthly wages are and enter those in. Payroll taxes auto-calculate based on these numbers down here, so you can change your payroll tax rate, your workers' compensation rate. I got it preset for 2.5%, but if you're doing welding or working in the oil fields or something like that, or working around heavy equipment, it's obviously going to be higher. Outsourcing for a restaurant, you might outsource cleaning, linen supply, somebody that comes in and brings in new rugs for the front door, uniforms, that kind of thing. We washed our own stuff, so we didn't outsource anything there. It could be contractors for your business. It could genuinely be outsourcing to companies outside of the country or some other place. But that's where you're going to put basically outsourcing as services. Our office expense was fairly minimal. It was about $50 a month for paper, toner, supplies, things like that. We didn't really ship anything, so we didn't have any shipping expense. We did have repairs on refrigeration. Obviously I'm going to put in $200 a month here, but it wasn't like it was $200 a month consistently. But let's say a refrigerator goes down, that's going to be $700, $800, $1,200 to repair, and that seems to happen every 6 months or 8 months or whatever. Our marketing and promotion consisted of printing flyers, and then inserting those in the newspapers, inserting them in the mailboxes on campus, and a few mailings like mailbox marketing, those kind of places that mail out flyers for you. Our total budget for that was $2,000 a month for printing and mailing in the whole 9 yards. Our other supplies around the store were about $200 to $250 a month. That was for cellophane to wrap the pizzas in, boxes, just general kind of cleaning supplies, those kinds of things. Our car and travel expense, we didn't provide the cars for the delivery drivers, so the car and travel was basically on our delivery drivers. They were paid a flat wage plus tips, and that's how that was paid for. Our lease expense was around $1,000 a month. Our telephones, generally you're looking at $30 to $40 per line, plus internet, so don't forget internet is generally a telephone expense. So we had 2 lines, so I'm going to say $60 for the telephones and then another $75 for the internet. Our utility expense was around $400 in the winter and around $200 in the summer, so we're going to put $300 in there just as an average. Again, you can make this seasonal, $300 in the summer months, $400 in the winter months, but that's up to you. Our insurance was paid actually in advance, so that was due up front, but you could conceivably have that as a monthly payment. Our premium was about $1,000, so it was about $83 a month. We didn't have any accounting or attorney's fees, again, because we did our own books and things like that. So, and then the property taxes our landlord paid because we had a gross lease rather than a net lease, so there was no CAM fee or property tax fee built into our lease. So then the only other expense we really had was credit card expense, so I'm going to go ahead and change this. It said banking fees, but I'm going to go ahead and change it to credit card. I'm going to put it in at 1%. Our actual rate was closer to 2%, but because only about half the people used credit cards, the other half used check or cash, I'm going to enter that in at 1%. So just so that you know, if you have a majority of your customers using credit card, obviously you'd put it in at whatever the rate is being charged through by your merchant account provider. So then down here we have expense growth, year 2. So remember how on the sales we said sales were going to go up by 15% on year 2? Well, that means expenses are probably going to go up a little higher than normal. If you're just trying to go up as much as inflation, that's generally around 2 or 3%. But since we were going to increase sales 15%, some of those other expenses are going to go up slightly with sales. And then in year 3, because we had 5% growth, I'll go ahead and put in a 3% growth rate, assuming inflation. The next tab then is the line of credit activity analysis. So you can see that we didn't really need a line of credit because the change in cash when we were over the 20,000 mark was we were making money. When we were under that 20,000 mark, we were losing money. But on the whole, we didn't really get, the cash balance didn't go below 0, so we didn't need the line of credit. If this ending cash that's bolded ever goes below 0 on your financial projection, that means that you ran out of money. And so either you have to come up with money on your own, or you have to have a line of credit to gap that funding, or you failed. So that's the whole point of doing financial projections, is not wanting to run out of cash, not wanting to fail. So here's where you would enter in that line of credit activity to increase your cash balance to sufficiently gap that line of credit use. Okay, so basically we've entered in all that information. The blue tabs down here are where you enter in the information. The black tabs or gray tabs are the actual pro formas, the actual spreadsheets that are created from that information. So this first one is the beginning balance sheet. You can see the cash on hand of $20,000, the inventory of $4,000. The equipment, furniture, fixtures, renovation, and tangibles. Those were all from that assets placed into service and startup cost tab. And then we go down here to liabilities, which is the line of credit, and then the cash that we put into the company plus the investment from the landlord. Those all come from the funding tab, and then again the assets placed into service are part of that built-in equity in the company. The income statement then, you'll see that the sales are transferred over, the cost of goods sold are transferred over. So sales minus cost of goods sold is our gross profit. All the other expenses that we entered are in there, plus our interest expense from our term loan. Note that we don't have principal payments in this tab. The reason for that is that they're not tax deductible. So this is what we would call an accrual-based profit and loss rather than a cash flow based. We do have depreciation expense in here, which is a non-cash expense. And then go ahead and adjust your tax rate based on the income that you've made. There's only $5,000 in income here, and so I'm not going to put in any taxes because if you only made $5,000, you're probably not going to have a significant tax liability other than self-employment tax, and that's paid at the personal level anyway, depending on the legal structure of your company. So then we'll go to the cash flow. Now this is the cash-based accounting of your profit and loss, and the most important thing to look at here is the net cash flow. You can tell that there are things like interest and principal. We've excluded depreciation. If you're a sole proprietorship or a limited liability company, here's where you would put your owner withdrawals of profits from the company, because technically on the expense tab here, the director's salaries are only if you're a corporation or an S corporation, because only in those two forms is an owner's salary tax deductible. So let's say that we didn't have an S corporation and my business partner worked there. We'll go back to the cash flow here and we could put his $2,500 draw in there instead. Again, the balance sheet, basically we want to make sure that this cash balance doesn't go below zero. And then we have our annual income projections, and from those percentages that we put in, year 2 you can see sales went up, year 3 we got close to that $300,000 mark, and then the expenses automatically adjusted based on the percentages that we put in on the expense tab. And you can see that the net income of this company is roughly $40,000, $44,000, and $48,000. When I put in that or change that owner's expense, that's pretty significantly changed that bottom line from the income projection on year 1. So I'm going to go ahead and put that back at 25%. The next tab then is the same annual projection for cash flow. Again, we're looking at the bottom line, the net cash flow. So my business partner took out his salary here under owner's withdrawal. So technically the company made $30,000 plus $6,000, $30,000 plus $10,000, $30,000 plus $45,000. And then again, an annual balance sheet. Here you can't really see if in any given month the cash goes below zero. So this is just the balance at the end of the month, but you can kind of monitor, is our cash in the account going up, those kind of things. And then the final tab is just a ratio analysis, typical financial ratios that the companies want, or the banks or investors might want to look at. You can plug in an industry average for these. The debt coverage ratio, banks usually want this number to be 1.25 or higher, and then there's some other typical financial ratios in there. Once you get it filled out, you want to go up here and click print. Make sure you select entire workbook, and then you can choose which pages you want to print. If you don't want to print the instructions or the inputs, so pages 8 through 15 might be the only pages that you choose to print, and then you go ahead and click OK, and then it would only print out those financials which get attached to your business plan. So I hope that helps you out with your startup. If you have any questions or anything, feel free to email me, and good luck with your startup venture.